Hi, Neil Rose here with an update. You've seen a lot of transactions and portfolios. We are taking some chips off the table, and not because the market keeps going up and hitting all-time highs. It's really about the way and the narrative behind it. Uh, Information technology, the biggest of the big tech, continues to do very well, but the prices are just astronomical, as are the expectations. I just don't think there's a lot of upside, or at least on a risk-adjusted basis, not worth betting on the horse that everyone thinks is going to win and win by a mile. These biggest of the big stocks in tech land comprise a bigger part of the market. That momentum begets momentum as investors then put more money into tech funds and tech stocks, as you see here on the right. So, it is a bull market, still a bull market, and we think it's time to just start fading it a bit or lower exposure as risk goes up and the upside reasonably becomes less. The the main assumption, though, behind all this really is interest rates. Always is, but especially now. Market, the Fed, everyone expects interest rates to keep coming down, or to come down, to start coming down imminently and forcefully. The problem with that is markets have expected that for a little while now, and it hasn't happened. In fact, the first rate cut was already supposed to happen, hasn't happened, and now the market is pricing things, assuming now that even the next Fed meeting won't result in a rate cut. So if rates don't come down, or come down as quickly and as strongly as the market expects, both in short-term and long-term bonds, I think people are going to really question the merits of buying 30, 50, 100, 150 times earnings stocks. When you can hide out and get 4.25 in 10-year treasuries, let's say, or any treasury now has a decent yield or real return above inflation or anticipated inflation, buying stocks becomes less attractive. The earnings yield in the S&P 500 is 3 2/3%. That's not great. That's not very high. Number is low and getting lower, really because prices are going up. Earnings yields are just an inverse of PE, but this is not sustainable. And I think markets may be very surprised that it's going to change, not because 10-year treasury yields and treasury yields in general go down. It might change because the earnings yield goes up, or investors eventually sell some stocks, lower prices, and those earnings yields increase. So we're just taking some chips off the table. If the market continues to do what it's doing, we'll participate. We'll be just fine. But increasingly, as things go up, it makes sense to take more and more off the table. And that's what we're going to do. So appreciate the time. Give me a call if you have any questions. Thanks.